What if I told you that the number one risk to your portfolio, it's not the Federal Reserve, it's not the big banks or Putin or China or inflation. What if I told you that the number one enemy to your portfolio, your success in investing, is actually there in the room with you right now? Scary, but it's true. And you need to only look in the mirror, because you are the worst enemy when it comes to investing, which is why I want to take a moment today to discuss investor bias. Specifically, what are the most common forms of bias, and while we can't get rid of them, how can we actually understand these processes going on in our brains? And because the more we acknowledge them, the more we can avoid them or take advantage of them by understanding more of this investor psychology. I'm Lark. I make videos on investing. If you like that topic, make sure to subscribe to the channel. Leave a thumbs up too if you do appreciate this kind of content. By the way, please sign up for my twice weekly cryptocurrency investor newsletter. Our members love it. I know you will too, so you got to check it out. You can sign up for free using the link in the description. Now, let's talk about bias. The first one, confirmation bias. This is when we tend to accept new information that basically fits into our already existing values and beliefs. It confirms what we already know. The validation makes us feel good, it makes us feel smart, makes us feel right. This means that we see the world how we want to see it instead of how it actually is. Let's look at an example. We all know a chart can be manipulated to tell us what we want to hear. So you find a bullish chart, something to support your existing beliefs on the market, and you ignore all the charts that would counter that opinion. Stay away from bad charts. I don't even want to see it. Now, a useful way to counter this is to actually find someone who disagrees with you, accounts who disagree with you, and listen to the other side until you're able to understand why they believe that. Maybe you disagree with that, but at least you listen and try to learn more. And of course, you need to be a bit flexible here. Learn to be okay with being wrong, and understand that it's okay to change your mind on things too. The next is loss aversion. We tend to be risk-averse creatures, us humans, focusing more on avoiding loss than finding ways to win. It's weird how we're hardwired, right? But the pain of losing tends to be much greater than the pleasure of winning. Money can be a highly emotional thing, which is why investors and markets go so crazy. So how does this manifest itself in your portfolios? Well, for example, by panic selling when the market dips a little bit, or alternatively, by holding on to losing positions way longer than we should have. Here's how to mitigate the effects of this bias. Set targets when investing. So before you enter into position, you should be doing this anyway, by the way, but before you enter into position, know your buy, know your sell targets, set limit orders, and chill. And of course, don't marry your bags. The aim in investing is to make more money and of course to keep your money. If something fundamentally changes with one of your investments, that's something that goes against your thesis of why you invested in that thing in the first place, cut ties, man. See you later, buddy. That's it. Next, let's talk about availability bias. Now, this is when we evaluate situations based on the most accessible or the most immediate information that actually comes to our minds. So basically, our minds mistake immediacy for importance. Therefore, we tend to massively overvalue recent information in our decision-making process. Now, here's an example of this. So the news cycle definitely sells doom and gloom to us on a daily basis. So when we are constantly exposed to negative events, to the crazy headlines, we actually start to have irrational fear over potentially low probability events like nuclear war, for example. Now, how do you combat this? It's by studying the data. Calculate what you think is the probability of an event actually happen. Try to find a balance. With too much information, you actually get overwhelmed and misinformed, and you kind of get into a state of not being able to make a decision. But with not enough data, you become ignorant and uninformed and you can't make a good decision. Also, trying to take a long-term view can help you really understand, the market cycles and all that stuff, so you don't get too distracted by all the day-to-day noise along the way. Now, the next concept that we need to discuss is the gambler's fallacy. Now, this is when we think that future possibilities are actually determined by past events. History doesn't often repeat, but it sure does rhyme, right? So here's an example. The S&P 500 has made an average annualized return of 11.88% since its inception. So it's going to do that every year, right? That is wrong. Some altcoin did 100x the last bull run, so it's definitely going to do that again the next bull run. That's also wrong. Some might, but most probably won't. The solution here, of course, is to do your own damn research. Let the data and the reasoning and the facts actually guide your decision. Rather than making everything about your ability to try and predict the future, try to be a little more scientific in your reasoning. Treat every event like a new beginning rather than a continuation of previous events. Now let's talk about the herd mentality. Now this is a tricky one when it happens because it's all about social proofing and what you see people talking about. And it's easy to follow the crowd. We're all guilty of this from time to time and go where the 99% are going, right? This comes from our human desire to fit in and find comfort in conformity. A simple example of this is when the markets pump, we see investors tending to FOMO in after a coin has already gone up 100 or hundreds of percent. The logic here is that everyone is in this coin, everyone's talking about it, it must be a damn winner, I need to get on board. Now to combat the herd mentality, you have to think a little bit differently. As Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Basically, he's saying, learn to be contrarian and go against the herd. Essentially, you need to let go a bit here. It's impossible to invest in everything. So look, if you've missed the boat on the big coin that's pumping right now or the big stock that's pumping right now, well, there's always going to be plenty of other investment opportunities to get into as the market moves through its cycles. And it's better to be early than late when it comes to these things. Now, let's talk about optimism and pessimism bias. Basically, we can be too confident about good outcomes and we can be too negative about bad outcomes. So here's how this actually works. So thinking, oh, I know the top is in, or I know the bottom isn't in yet, or this coin's done 100x and I'm still not selling yet. I'm just that optimistic about its future. Sound familiar? Well, we've all made those mistakes. Our judgment can be clouded when we're too close to it. Again, fear and greed, they totally screw your mind up. Now here's how to try to avoid this trap. Do a trial run. Before you invest in something, consider what could actually go wrong and why, so you're prepared if they do go wrong. And then stick to your plan. Know your entry points, know your exit points, know why you might cut a coin, right? Don't get distracted by fear and greed along the way. It's easier said than done, but it's very essential for successful investing. And finally, let's talk about survivorship bias. This is where we overestimate the odds of success because we only hear about success stories. There are so many successful investors to look up to in markets and to aspire to be like, right? They're famous names, Warren Buffett, Ray Dalio, and Peter Lynch, right? But these aren't representative of all investors. There are plenty of bad investors out there as well. For example, you might see stories like, the US student who made $110 million trading Bed Bath & Beyond stocks. That's a real headline, but it also forgets to mention that he had help of his rich family that gave him like $20 million and he YOLO'd it on Bed Bath & Beyond stocks and won. It's like gambling almost. Because for every success story, there are countless investors and traders who have lost money, or successful ones who had a lot of help that's not always mentioned. So you need to be realistic, right? The game that you need to play is your game. And whilst the viral success stories do show that it's possible, right? We must be realistic about the probability of such, crazy gains, right? You also want to study the failures too. We can learn as much from people's failures as we can from people's successes, if not more, actually. Anyway, I hope that this video was useful for you. I know we've all been there, we've all done these mistakes, me included, right? I hope it can help you become a better investor, or at least give you a framework for how to think about how your mind is working when it comes to investments. Anyway, let me know what you think about all this down below in the comment section. Thanks for watching today's video, and peace out till next time.